Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how you go about maximising your borrowing capacity. Now, over the last year or so, borrowing capacities have reduced by around 30%. Mainly due to two reasons. Firstly, APRA increased the interest rate buffer that a bank must apply to current interest rates to test your serviceability from 2.5% to 3%. And then, of course, the central bank, the RBA, has been on a course of dramatically raising interest rates over the last period of time, last 8 or 9 months. And that's had a negative impact on people's borrowing capacities. So what I wanted to do is share a few tips on how to maximise it, because maximising your borrowing capacity obviously increases your ability to invest. And if you're investing in great quality assets in the long run, that's going to generate a lot of wealth for you. Now, of course, I've said several times in this podcast that building wealth is a marathon, not a sprint. And whilst it's good to avoid procrastinating and not be too conservative and so forth, and invest as much as possible, you should never take silly risks. And when borrowing, it's really wise to really plan for the worst and hope for the best. So looking really closely at your spending habits, thinking about any potential changes in income and so forth. Don't rely on variable income, at least not completely, like bonuses and so forth. And make sure you factor in your ability to repay at higher interest rates. Even if you think those higher rates are unlikely, it's always good just to make sure that it's going to work. And as a rule of thumb, I reckon if you're borrowing any more than, say, 6 to 8 times your gross annual income, you've got to start to be careful. That can be a warning sign that you're borrowing too much, and you need to really consider the risks and make sure you have an exit strategy if everything goes pear-shaped. The thing is, though, in my experience, last 20 years of experience, I think in the main, or almost always, it's unnecessary to borrow huge amounts of monies to achieve your goal. And in fact, the portfolios that I've seen with large amount of debt tend to be a consequence of investing in the wrong type of assets, poor quality assets. So I saw one the other day, a portfolio of 10 properties with $5.6 million of debt. And those people were certainly borrowing more than 6 to 8 times their income. It's just unnecessary. It's unnecessary to have $5.6 million of lending for those particular clients. They were on very healthy incomes, but not massive incomes, and it's a lot of risk. Whereas I would much rather have, one really great quality investment grade property, have $1.5 million of debt against that property, and really, depending, as long as I've got other assets that I'm investing in as well, I probably don't need much more than that, because that property, $1.5 million property, is going to be worth $3 million in 10 years and $6 million in 20 years. So if it's worth $6 million, I've got $4.5 million in equity. Now, $4.5 million in 20 years' time isn't $4.5 million today, of course. But the point I'm trying to make is borrow very carefully. Don't over borrow, and you've just got to be really conscious of the risk. Now, having said all that, because I think it's really important to put a bit of context around the topic today, there's going to be situations where clients can afford to safely borrow more money, but because of their circumstances, the bank won't allow it because of the way that they calculate your borrowing capacity and serviceability. So the point of this podcast then is to help people kind of navigate those situations where you're able and willing and comfortable to borrow more, and it's really about finding a bank that's going to lend you more. So I've got a bunch of tips here, and I'm just going to speak to each one as we go through. Okay, so the first one is use a charge card instead of a credit card. This is a change that my wife and I made a few years ago, and really after many decades of actively investing and using different banks, we didn't realise that my wife and I ended up with 7 credit cards. Some were in her name, some were in my name. And notwithstanding that, the annual fees on those cards is an incredible waste of money, the aggregate credit limit was well into six figures, well over $100,000. And it was eating into our borrowing capacity, because what the bank will do is they'll include a percentage of your credit card limit as a monthly expense. So most banks around 4% of the credit card limit. So $100,000 of credit card limits meant that the bank assumed we had a $4,000 per month repayment commitment, because obviously the bank just sits back and thinks, well, if you go and max out those cards, what would your repayment be, since they're already in place? And so it can have a pretty big impact on your borrowing capacity. And since my wife and I repaid the cards in full each month, we weren't really using them as a source of credit. They were merely only used really to generate points, credit card points. So a few years ago, we cancelled all but one of them. We left one, we just used one for business. And we got a charge card from American Express. And we pay for as many purchases as we can using that American Express card. The advantage is that it's a charge card. It doesn't have a credit limit. So it means a charge card means you've got to repay the balance each month, which we did anyway. And so it means it doesn't have an impact on borrowing capacity, and notwithstanding that, we're saving a bit on credit card fees as well. So think about your credit card limits and what impact they might be having on borrowing capacity, and that's one change you might consider making. Okay, my next tip is about changing jobs, particularly if you've got a variable income component. So many employees will have a variable component of their overall remuneration package that's either contingent on personal and or company performance, whether you call that a bonus, a short-term incentive, STI, whatever name it's going to come under. Most banks will include 80% of bonus income in serviceability as long as you've got 2 years' worth of history. So the problem then can arise is if you change employers, and whilst you might be doing the sort of same occupational role, if you like, and you might have a really long history of earning bonuses, and the intention might be that your expectation is that the bonus level will be the same at this new employer as well. Until you've got 2 years of history, most banks won't look at it. Now, if you can demonstrate that you're really in the same occupational role, and you've gone, say, from a CFO from one company to a CFO at another company, for example, well, then some banks will say, well, as long as we've got 1 year's worth of history, we're happy with that. The point being that sometimes or quite often, that variable income, that bonus income, can be quite important in terms of maximising borrowing capacity. And so if you are contemplating a change of employment and your remuneration does have a component of variable income, then you might want to consider potentially executing on those borrowing capacity requirements before you make that change, or instead realising that there's going to be some period of time until you can maximise your borrowing capacity at your current or your new employer. And the next step, it really relates to people that are self-employed. I mean, there's a myriad of things that accountants might do in order to maybe manage or minimise or reduce your tax liabilities that have unknowingly negative consequences with your borrowing capacity. So, for example, I'll give you a couple of real-life examples for clients that we've been working on. If we've got large depreciation expenses in a business, sometimes you can provide the lender with some support to show that depreciation, those assets that you've purchased and are depreciating don't need to be replaced for a long period of time, and so they'll add that depreciation back. Sometimes structuring, for example, instead of paying out unfranked dividends, paying out a salary instead of dividends can appease some lenders. Pretty silly, really, but that sometimes you just need to do things to comply with lenders' credit policies, even though they don't make a lot of sense. Distributing to family members outside of your immediate family. So some clients distribute to parents, for example, obviously to spread that tax burden amongst more taxpayers. But again, some lenders don't particularly like that. So in that situation, we might structure distributions a bit differently. Sometimes prepaying your BAS, so PAYG instalments, so that the company has enough franking credits to be able to pay a fully franked dividend in that financial year. If we know we want the borrowing capacity, we want to be able to do that. sometimes that can make a bit of sense. So they're just some examples that I've thought off the top of my head. The point is that a lot of these matters are quite technical, and most non-accountants and non-brokers, mortgage brokers, won't really pick up the nuances. So that's why it's really important, I think, for your broker and your accountant, your holistic accountant, to speak to each other to make sure whatever they're doing on the accounting side isn't going to limit your borrowing capacity. In addition to that, it's also important to choose the right lender. Some lenders just don't suit self-employed people, applicants, I should say. And so sometimes it's like trying to fit a square peg into a round hole. It just doesn't work. So choosing the right lender is important, but also making sure you're at the front end of it to make sure you're structuring things that aren't going to cause any borrowing capacity problems. My next tip is to sort of rein in spending around sort of 3 to 6 months before you make an application. You'll have to itemise and declare your living expenses in an application now. So they'll have maybe close to sort of 10 different categories that you need to complete in terms of living expenses. And therefore, the bank will sometimes quite often will look at your, a month's worth of statements to verify that what you've stated is broadly correct. And so sometimes reducing your spending serves two purposes. Firstly, you'll be able to declare a lower spending habit on the application form, thereby extending your borrowing capacity. But secondly, and arguably most importantly, it will demonstrate to you, how low can you reduce your expenses. So that way you can make decisions based on that outcome, or that information, I should say. So, for example, you might decide to borrow a certain amount, full well knowing that you might have to cut back the amount of money you spend going out to dinners or something like that. But at least you can proactively, logically make that decision before you make a loan application, rather than be forced into that decision after you've actually applied. So cutting back the expenses and really working out what do we have to play with in terms of income to contribute to a loan if we have to is a really prudent thing to do. My next tip is to reset or consider resetting loan terms. If you have a loan that you've taken out a while ago, when you initially took out that loan, it would have most likely had a 30-year loan term. And the longer, the deeper you get into that loan, obviously the shorter the remaining loan period, and that increases your repayments. And particularly, it's the case if you've had a loan and you've made a lot of extra repayments, so the balance is a lot lower than where it was supposed to be had you not made those extra repayments. What the bank will do is the bank tests your serviceability based on the original loan amount and the remaining loan term, because that's how principal interest repayments are contracted within the loan agreement. Now, if you've had a $700,000 loan 5 years ago and the balance is now $500,000 because you've made extra repayments, the repayment amount's going to be sort of maybe around just short of $4,000, assuming the interest rate's around 5%. Now, if you recontract that loan, that $500,000 balance, back over to another new 30-year loan term, your minimum repayments reduced to closer to $2,500, so quite a lot lower. And that allows you then more borrowing capacity for any new borrowings and so forth. Even though you recontracted that loan over 30 years, it doesn't stop you from making extra repayments. So if you just want to keep repaying that loan as fast as you can, and if it's a home loan, that's exactly what you should be doing, you can still do that. But thinking about your loan terms and how much they have an impact on your existing commitment amount can also extend your borrowing capacity. Which kind of brings me into my next tip, which is really about interest-only terms. So a home loan normally has a 30-year loan term, and if you have an interest-only home loan, what they do is they chop that loan up into two segments. So the first 5 years is interest-only, and the remaining period is 25 years. It just means that you've got to repay that loan over a 25-year period, which increases the principal interest repayment amount. So to extend your borrowing capacity, you might instead ask for a 2-year interest-only period, because that gives you 28 years to repay the loan, or in fact have a completely principal interest loan. Now, of course, that's not going to serve everyone, and you've got to think about what happens when the interest-only term expires And it might not suit everyone to have repayments on a principal interest basis, but the interest-only term does have an impact on maximising your borrowing capacity. So that can be something you can think about even as a temporary change. Some other quick tips I can mention is car leases. Car leases can have large monthly repayment amounts, and that can have an negative impact on borrowing capacity. So if you think about upgrading your car, maybe do that after you've made any changes to mortgages. If you have a HEX debt, or what's called a help debt now, if you're a younger person and still have that debt that relates to university studies, sometimes it's better to repay that debt in full because the repayments can be quite high now, and that reduces your borrowing capacity. And if you have children that are in private schools, then most, if not all, banks are going to include the fact that you've got this private school fees that's going to reduce your borrowing capacity. Although if your kids are in year 8 or later, some banks will actually exclude school fees. So again, finding the right bank that's going to have the right borrowing capacity is really important. So there you go, there's some tips to help you maximise your borrowing capacity. Of course, everyone's situation is different, all lender policies are different and so forth. These are just generic tips. So there could be more things that you can do to extend your borrowing capacity. If there's anything that we can help you with from a borrowing capacity mortgage broking perspective, you're most welcome to reach out to our senior mortgage broker, Jodie McEwen, and her contact details, email details, are on the blog on the website. So if you need that help, reach out to her. She's got heaps of experience. Okay, that's it for me for this week. Until next week, bye for now.